Imagine you're staring at a company's Q1 earnings report and you see top-line revenue absolutely explode by 167%. They completely crush Wall Street's expectations. You'd naturally assume the market is throwing a massive parade, right? Well, with rocket companies, the exact opposite happened. The very moment they posted that massive revenue beat, Wall Street aggressively hit the sell button. It's a glaring, almost unbelievable paradox, and it's the exact tension we are unpacking in this explainer today. On one hand, you've got undeniable growth. We're talking $2.94 billion in revenue for the first quarter of 2026. On the other hand, a brutal 20% haircut over the next 30 days. So what exactly is the market so terrified of? Is Wall Street completely misunderstanding a structural turnaround here? Or is there some massive hidden risk lurking just beneath these growth numbers? Let's figure this out. To really grasp this disconnect, you first have to understand that rocket companies is fundamentally not the business it was 3 years ago. Just look at this number, 10 million. Through their all-stock acquisitions of the real estate brokerage Redfin and the mortgage servicer Mr. Cooper Group, Rocket has built this massive integrated ecosystem. They now address a combined portfolio of nearly 10 million clients. They are no longer just a cyclical, transaction-driven lender that lives and dies on the whim of whatever mortgage rates are doing today. No, they've actually transformed into a vertically integrated fintech platform. They're capturing economics across the entire digital homeownership lifecycle. We're talking real estate search, mortgage financing, loan servicing, title, closing services, the whole shebang, all within a single ecosystem. And this ecosystem is purposely built to target a normalized annual mortgage opportunity of roughly $1.9 trillion. But here is where their competitive moat gets incredibly deep. When you originate a mortgage, somebody eventually has to service it, right? Collecting the payments, managing escrow, all of that. Most smaller lenders just sell those servicing rights off, but Rocket retains them for 20 to 30 years. That creates a $2.1 trillion servicing portfolio that acts like a giant captive funnel. When those clients eventually need to move or refinance, Rocket recaptures them at a staggering 83% rate. The industry average is sitting way down at 25 to 28%. To put that in perspective, Rocket is feeding a self-reinforcing flywheel that generates high-margin origination volume with practically zero new marketing spend. And they are pouring serious gasoline on this flywheel. Rocket has dumped over $500 million into their proprietary agentic AI platform called Rocket Logic. Now, I know AI is a buzzword right now, but for Rocket, this is the literal game changer for their operations. By completely automating initial document reviews, chat interactions, and outbound messaging, they've practically eliminated manual prospecting for their loan officers. The result, this AI integration is already adding an incremental $1 billion in monthly volume. They can now scale their origination capacity up to $300 billion while employing hundreds fewer operational staff than they did in previous cycles. That is the definition of pure operating leverage. Okay, so pause for a second. We have a company with an 83% retention rate, massive AI-driven scale, and 167% top-line growth. If this operational flywheel is spinning faster and more efficiently than ever before, why on earth did the market hit the sell button? Let's pivot to this central conflict and look at what's keeping Wall Street awake at night. The bear case here is actually really intelligent. It boils down to some severe macroeconomic and competitive headwinds. First, right after Rocket posted those stellar Q1 results, Freddie Mac's 30-year fixed mortgage rate marched right back up to 6.55%, and weekly mortgage applications broadly fell 2.7%. The market instantly priced in a near-term freeze in origination volume. Second, there is a vicious wholesale price war happening right now. United Wholesale Mortgage, UWM, controls over 40% of the wholesale broker channel, and they're using incredibly aggressive pricing tactics. They are literally slashing their own margins just to drive volume and squeeze out competitors. The market is terrified that UWM's scorched earth strategy will permanently compress industry-wide margins, and Rocket is going to get caught in the crossfire. But let's actually look at the hard evidence from their May 7th, 2026 earnings report, because the actual numbers forcefully challenge those market fears. They reported total GAAP net revenue of $2.94 billion, beating analyst estimates by 7.3%. Adjusted diluted earnings per share came in at 15 cents, smashing estimates by a massive 25%, and adjusted EBITDA hit $738 million. This wasn't just a mild earnings beat, it was a comprehensive flex of their new scale, heavily fueled by realizing $140 million in Redfin cost synergies in just 6 months. And the bottom line turnaround? It's a complete 180. Back in Q1 of 2025, Rocket posted a GAAP net loss of $212 million. Fast forward exactly 1 year to Q1 2026, and they are delivering GAAP net income of $297 million. Even more importantly, when you exclude the correspondent channel, their gain on sale margin actually reached 322 basis points. That's the highest margin level they've printed since 2021. It firmly proves that their direct-to-consumer, fully integrated model is successfully shielding them from UWM's wholesale price wars. Management knows exactly what's happening too. On that Q1 2026 earnings call, CEO Varun Krishna was crystal clear, stating Rocket is no longer the same business it was 3 years ago. They also confirmed that their massive $400 million annual run rate synergy target from the Mr. Cooper acquisition is fully on track to be realized by the end of 2026. That is a full year ahead of schedule, folks. They've already migrated over half of that acquired servicing portfolio right onto their unified tech platform. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed, because it's numbers like this one that completely rewire how you value a business. $5 billion. That is the annualized recurring cash flow generated by Rocket's $2.1 trillion servicing portfolio. This is their absolute secret weapon. Think about it. When mortgage rates spike and new origination volumes dry up, the value of this servicing book actually increases because people stop prepaying their mortgages. So this $5 billion acts as a massive counter-cyclical hedge against the exact rate volatility that Wall Street is panicking over. When we synthesize all of this data into a qualitative scorecard to evaluate the overall business quality, Rocket earns a very strong blended score of 7.6 out of 10. Management alignment is exceptional at a 9 out of 10, primarily because founder Dan Gilbert still owns over 90% of the economic and voting shares, so leadership is perfectly aligned with long-term value creation. Market position is also a 9 out of 10. I mean, they are officially the largest mortgage servicer in the country. The one thing dragging the score down is analyst sentiment, which sits at a 6 out of 10. Wall Street currently has a mixed hold consensus on the stock, clearly proving they are hyper-focused on near-term macro headwinds rather than the long-term cash generation of the platform. Now, I want to quickly mention that all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years; hidden gems, under-the-radar names with asymmetric upside; and dividend hunters, durable income with the fundamentals to back it up. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of your screen. Scan it to download the Flash Shop and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, before we dive into the valuation math, I need to state this clearly. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. Also, just a heads up, the full detailed model with all the underlying assumptions is available for free at flash.stocksentinel.ai. Okay, let's break down the 5-year scenario matrix relative to Rocket's recent share price of $13.05. When we model out the underlying operational mechanics, we arrive at a probability-weighted price target of $17.68. That implies a solid 35.5% potential upside from current levels. We're assigning a 50% probability to the base case, a 30% probability to the high case, and a 20% probability to the low case. But remember, the target price is just the mathematical output. We really need to understand the exact operational assumptions required to actually get there. So for the base case, which brings us to an implied price of $13.47 and assumes a 22 times PE multiple, what actually has to happen? Operationally, this requires a moderate housing recovery, with interest rates stabilizing somewhere between 5.0% and 5.5%. It also assumes the flawless ongoing integration of the Redfin and Mr. Cooper acquisitions, fully realizing that $400 million synergy target. Under these conditions, the scale efficiencies from their AI integration push them to a $14.8 billion revenue engine, maintaining a very stable 12% net profit margin. The extremes here perfectly highlight the asymmetric risk-reward of the stock. The high case targets $35.05 per share. But for that to happen, rates must fall below 5.0%. That would unlock a massive tidal wave of refinances across their $2.1 trillion servicing book. It also requires the Redfin mortgage attach rate to exceed 50%. If they pull that off, margins expand to 18%, and the market likely awards them a 30 times premium tech multiple. Conversely, look at the low case. This implies a steep drop to $2.14. This scenario is a severe, higher-for-longer macro freeze, where rates stubbornly stay above 6.5%, wholesale price wars decimate margins, and they totally stumble in integrating Mr. Cooper's massive portfolio. In this world, their net margin drops to a painful 4%. And that brings us perfectly into the risks, because the threats to this thesis are very real, and you need to watch them closely. The primary execution risk is integration failure. Migrating 10 million servicing accounts onto one unified tech platform is incredibly complex. The early warning sign you have to watch here is any drop in their 97% net client retention rate. Then there's the competitive threat we discussed earlier. If UWM's wholesale price wars start to bleed over and permanently damage Rocket's partner network segment, keep a hawk eye on those gain-on-sale margins. If that number falls below 2.5%, the long-term thesis is taking structural damage. And of course, the macro risk. If REITs march back above 7%, consecutive flat origination quarters could trigger persistent cash burn. There are also some hidden risks lurking just beneath the surface. Back in the spring of 2025, several U.S. senators began pressuring the DOJ and FTC to formally investigate Rocket's vertically integrated model. Their concern? Anti-competitive cross-steering. Basically, they're worried Rocket is forcing Redfin users into Rocket lending products. Any serious regulatory crackdown here would severely cap their future growth runway. Also, note that funding these massive acquisitions pushed their net debt to tangible equity up to 1.1x. It's totally manageable right now, but it definitely reduces their financial flexibility if credit markets suddenly tighten up. So bringing this all together, here are the 3 critical takeaways that completely resolve our opening paradox. First, the 83% refinance recapture advantage. Rocket converts their servicing clients into high-margin originations better than literally anyone else in the industry. Second, the $5 billion encounters cyclical cash flow coming from that servicing book, providing a massive financial buffer against rate volatility. And third, AI-driven operating leverage, using Rocket logic to permanently strip out structural overhead. Yes, the market sold off the stock 20% because of near-term rate fears and competitive noise, but the underlying business has fundamentally transformed its scale and efficiency. Which leaves us with the ultimate question. Will Rocket's massive $2.1 trillion servicing moat successfully bridge the gap to the next housing cycle? The tension between near-term macro reality and long-term platform value is exactly what makes this setup so fascinating to watch. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.